All right, well, thank you all for being so prompt. Once again, I'm Kevin Hassett for the American Enterprise Institute, if you just joined us. And in this session, we're going to hear from two of really the top tax experts in town. Barbara Angus is the Chief Tax Counsel for the House Ways and Means Committee. She was previously a principal with Ernst & Young, where she was leader of International Tax Policy Services. So you know something about international tax policy, the topic of the conference. I'm just an economist, so I know about it in models and stuff, but I don't actually do it. Earlier in her career, she served as International Tax Counsel for the Treasury Department, principal with PricewaterhouseCoopers of the Federal Tax Policy Group, and Business Tax Counsel for the Joint Committee on Taxation. She received her bachelor's degree from Dartmouth College, her JD from Harvard Law School, and her MBA from the University of Chicago. It's a kind of nice set of schools. I'm going to insert moderator preference here. That Barbara is the Chief Tax Counsel for the House Ways and Means Committee. She's going to talk about a blueprint that came out last summer. The audience, the moderator will frown upon members of the audience who try to tease details that haven't been made public out of Barbara. We won't stand for that, so we're going to talk about the blueprint. And Barbara's going to go first after Barbara. Then we're going to go to Robert Stack. He's the Deputy Assistant Secretary for International Tax Affairs in the U.S. Department of Treasury. He's also the reporting authority for the Office of the International Tax Council, provides advice and counsel to the Assistant Secretary related to international tax policy and tax treaties, and officially represents the administration's interest in international settings, which sounds like it at times must be really fun. You get to go to cool places. Although we have to talk about tax, I guess. And Robert is going to give us, the original design of the session was that we were going to talk about a specific Treasury proposal. I think that he's going to do a little bit of that, but also give us some wisdom should people want to legislate going forward based on his experience over at Treasury. And with that, I'll begin with Barbara. Barbara, thank you so much for joining us.
Terrific. Thank you. It's a pleasure to be here today, and it's a pleasure to be here with Bob and with you. I'll just start with just a small housekeeping note that the views that I'll express are my own, and I'm not speaking officially for the chairman or the committee. With that, when the conference was organized, I was asked to talk about the House blueprint for tax reform, and I'm very happy to be here talking about that. The blueprint was released on June 24th. If anyone is looking for it, I have a dog-eared copy here, and you can find it on waysandmeans.house.gov/tax-reform, and lots of materials on it. So I thought I'd start just by talking a little bit about the background, about how we got to the blueprint, because I think that's really important in looking at the design of the blueprint, and it's also important looking forward. The blueprint builds on the work of the Ways and Means Committee on tax reform over the past 5 years. A very intense process led first by then Chairman Camp and then by then Chairman Ryan, focus on all aspects of tax reform. I think Chairman Camp's tax reform draft really showed that comprehensive tax reform, that a full comprehensive tax reform package was possible. Chairman Brady often says that he believes that Chairman Camp's package also helped to make comprehensive tax reform inevitable. Chairman Ryan continued the focus on both the urgency and the importance of tax reform. At the beginning of this year, the members of Ways and Means were really eager to continue the work and to expand the dialogue. And I think in that regard, Speaker Ryan's Better Way project, his project focused on 6 key policy areas to get House Republicans looking at and building consensus on ways to improve the lives of Americans in these 6 policy areas, including tax reform. that project really provided a terrific opportunity. It provided a framework and an infrastructure for expanding the dialogue on the details of tax reform, on the challenges of tax reform, and on the urgency of tax reform beyond the committee and with the conference at large. The Tax Reform Task Force was unique among the 6 task forces. In all of the other policy areas, there were multiple House committees of jurisdiction. For tax, there is only one House committee of jurisdiction. So the Tax Reform Task Force was a task force of 1 with Chairman Brady, the only member of the task force. So maybe because of that task force met more often than any of the other task forces.
In continuous time, in fact.
So we had weekly meetings when the House was in session, and really a terrific dialogue. We looked at and heard from members of Congress that have developed bold proposals for completely overhauling the tax system. We also heard from members of Congress that had developed more targeted proposals within the context of the traditional income tax system. We had a dialogue with economists about the ways in which the tax code designed appropriately could help drive economic growth. And the blueprint really is the culmination of those discussions in the task force and the hard work of the members of the Ways and Means Committee. In looking at sort of the factors that became an important focus, I mean, certainly there are lots of factors that point to the need for tax reform. I think I'll just mention a couple that resonate particularly today and that were an important part of the dialogue leading up to the blueprint. And both are things, they're not new developments. They clearly are developments that are a culmination of lots of occurrences over time. And one is just a clear expression of the public frustration over our current tax system. The American people are fed up. They think the tax system is way too complicated. We're at a point where we've got sort of the average man on the street thinks that everyone else is getting a tax break except him, and that kind of frustration with the system is a real problem with a system like ours that's based on self-reporting and voluntary compliance. It shakes confidence in the fairness of the system, and when you look at the compliance burden, Tax Foundation did some work, came out with numbers earlier this year that estimated that the cost of tax compliance in 2016, Americans will spend over $400 billion and 8.9 billion hours complying with their tax obligations. That's a lot of time and money that could be spent elsewhere. I think you would probably have better ways more productive uses for that time and money. Another critical factor that was a real focus this year is the changes in the international tax environment and the ways in which they are creating further and more urgent pressure on the current U.S. tax system. We've got the OECD BEPS project, the developments coming out of the BEPS project in countries around the world, sort of the BEPS plus developments as we see multiple countries making changes, sometimes in unison, maybe more often than not in different ways or to different degrees. We've got the EU state aid cases, and while the European Commission and others deny that U.S. companies have have been deliberately targeted. I think there's no denying that U.S. companies are in the crosshairs, and the lockout effect that encourages U.S. companies to build up foreign earnings offshore is a significant factor. Other countries don't have systems that put their companies in the same position. So I know, well, I'm hoping that Bob will talk more about developments there, given the really important role that Bob has played in advancing sort of the U.S. concerns in this area. But it really does drive home the need to address the issues that we've long known we needed to address in our international tax system. Chairman Brady often says that tax reform happens only once in a generation. It's one of his favorite lines. It's actually one of my favorite of his lines because it resonates for me in a really personal way. I started in 1986 sitting in Al Warren's corporate tax class, learning about the 1954 code and these ideas that people were talking about in Washington for potentially changing it. I ended that year as a brand new associate in the tax department at a law firm in Chicago, in meeting after meeting, learning about all the reforms that were reflected in the '86 Act and what the new 1986 tax code looked like. I remember thinking at the time, having this sort of sudden feeling that this was a huge advantage for me, because no longer did the more senior lawyers in the department, the partners, have an advantage because they knew the tax law, because it was all new. I learned pretty quickly that they still had an advantage. But I'm looking forward to a next generation that experiences that same feeling. Anyway, the fact that tax reform does real big tax reform happens only once in a generation clearly affects how you need to look at what that tax reform should be. And it certainly has affected the views of the members of the Ways and Means Committee. The blueprint reflects the members' commitment to bold reform. Tax reform is difficult, it's complicated, it's disruptive, and it doesn't happen very often. And so to a member, they all concluded they needed, that what we need is bold changes, bold reforms, and reforms that will stand up will last for a generation if they need to. At the same time, I think the blueprint reflects the members' prioritization of reforms that will drive economic growth. They listened to what they heard from the economists, and clearly have a view that the biggest benefit that the tax code can provide is not sort of a particular tax break, but the biggest benefit is helping to grow the economy. So with that sort of background, just sort of an overview of the key elements of the blueprint reforms. Blueprint does contemplate comprehensive reform, so individual reforms, business reforms, and international reforms, and also a restructuring of the IRS. The idea being that we need to better align the tax administrator with this newly restructured tax code. I think it's fair to say that really all elements of the tax reform are very much interrelated. So while I know we've got an international focus today, I'll touch on each of the areas. On the individual side, the reforms are very much driven and informed by what members hear from their constituents all the time, is they want a simpler system. And sort of a clearer system, one that they can understand better. So the blueprint provides for lower and flatter rates. It also provides for further reductions in the tax on investment income, capital gains, dividends, and interest in order to drive savings and investment. It eliminates the corporate minimum. It eliminates the individual alternative minimum tax, which is requires individuals to calculate their tax twice every year. It eliminates the estate tax. It retains some key provisions that are important for life events, but otherwise contemplates the elimination of special credits and deductions in favor of lower rates and a simpler system for all. On the business side, very much a focus on driving growth in the economy. So a 20% corporate tax rate, a recognition of, in today's economy, the importance of addressing not just the business done through corporate solution, but the huge amount of business that's done today in the United States outside of corporate solution. So provides for a 25% business tax rate for income earned through a pass-through or a sole proprietorship. It provides for immediate and full expensing of investments in tangible and intangible assets. The economists tell us that that is the number one tax provision that can be used to drive growth and encourage investment. It provides for the elimination of deductions on net interest, a provision that often is viewed as going hand in hand with an expensing provision. It provides for carry forward of NOLs with interest for the first time, so NOLs don't lose their value over time, and it eliminates the corporate AMT. On the international side, the blueprint contemplates reforms that I think really are transformational. I'll start with border adjustability. The core tax system reflected in the blueprint is a move toward a cash flow tax, and that allows us to look at border adjustments such as are used by our trading partners. And so the blueprint contemplates an elimination of tax on exports and an elimination of the effective current law subsidy for imports. It also contemplates a territorial system, 100% exemption for dividends brought home from foreign subsidiaries, as many of our trading partners have, and also reforms in the Subpart F area that will move in the direction of making our CFC rules look more like those of other countries, and focus in particular on passive income. As a transition into the new system, the deemed repatriation provision with respect to old earnings that has been included in many of the reform proposals that would move to a territorial system. Really, the bottom line for the international section of the blueprint, and I really shouldn't separate that from the business rules because they're important here as well. The idea is to eliminate tax as an incentive to locate outside the United States. Just a couple of final comments. The blueprint was intended as the beginning of a conversation, and with tax reforms as bold as some of these reforms, we appreciate that feedback is critically important. Since the release of the blueprint, we've gotten lots of valuable input. So the conversation has continued as the committee and the staff have focused on the work of building legislation based on the blueprint. When the blueprint was released in June, the Speaker and the Chairman said that the plan was to be ready to move tax reform legislation in 2017. The Speaker and the Chairman have been clear about their excitement about the opportunities to work with the President-elect and his administration to make pro-growth tax reform a reality in 2017. And as someone who entered the tax profession just as the last big tax reform was being finalized, from a personal perspective, I certainly couldn't be more excited about the opportunity to be a part of the team that contributes to the effort to get tax reform done next year.
Thanks so much, Barbara. And I know that I speak for everybody in the room that it gives us all calm and peace of mind to know that someone with your experience is in there, getting ready to draft legislation and get the language right. Bob Stack.
Thank you so much. First of all, it's a delight to be here today. It's a perfect time to be looking at the various options that'll be before the country as the next administration moves in. My comments today, really for the first time that I've spoken publicly, are solely my own. I don't come today with U.S. Treasury views on the House proposal, future proposals of a future administration. My job at the Treasury Department in my remaining time is to do the best job possible to create an efficient transition to the new administration, and I'll be focused on that. But I have learned things in my almost 4 years at the Treasury Department that I did want to share, because I think these things will flavor the ongoing debate. We know that there's the House blueprint. We know that the Senate had been working on plans on integration. We know that the incoming president will have some ideas on tax reform. So all of these things will be part of what Barbara described as a conversation, and I just wanted to share today some perspectives on my job that might influence the conversation. First of all, I think I want to re-emphasize something that really came up in the last panel, which is the degree to which in the international tax debate, the mobility of capital, the mobility of income subject to intangible property and rents, and difficulties around questions of residence really are at the heart of issues that have put extraordinary pressure, in the international tax space. And I think for a group like this, I mean, in a sense, that's the headline, and that's what all of these different plans are trying to struggle with, is the interplay of these difficult questions, added on to which, and very closely related, let's say from a U.S. perspective, a pressure for inversions is what, a lot of this game is all about. But going over, I represent the United States in the Organization for Economic Cooperation and Development. I'm the lead delegate there, and I've worked very hard on the base erosion and profit shifting program over the last several years. It's also important for these audiences to appreciate the growing role of the G20 in asking questions about international tax policy and putting policy questions front and center, not just for the US, but for the G20, and also, as I'll talk about in a minute, for developing countries as well. And as the U.S. begins this tax reform debate, I think it's, or continues it, I suppose, what I think we have to be very, very conscious of, and it was also came up in the last presentation, is the degree to which U.S. multinationals around the world are viewed as not paying their fair share of taxes. And I don't want to steal from Mick and Mike's next panel, but it is not possible to separate out that fact from what will be happening in the global space going forward. And we need to be asking ourselves, how does that tie back to U.S. international tax reform? The first point I'll make about that, and we saw the statistics for where the income goes into the low tax jurisdictions. And what's really critical for U.S. audiences to appreciate about those statistics is it's not just the lockout effect, the deferral of U.S. tax, that puts the pressure, but it is the fact that the U.S. multinationals, as Ed pointed out, are able to use the international tax structure to strip income from higher tax jurisdictions into lower tax jurisdictions, kind of to a fare thee well, and that has created and will continue to create enormous pressure in the U.S. tax space. Now, this adds to extraordinary uncertainty for investors around the world. And the uncertainty comes in many forms. First, there are laws almost every day being proposed by countries around the world that are very concerned about this phenomenon and want to stop it. Second, and really important as this idea of minimum taxes, which may fade away in the future debate, but I want to return to a point, because many of these changes we're seeing in countries around the world are what I'll call backdoor minimum taxes. In other words, if you're paying a royalty out of my jurisdiction to a low tax place, we're just going to suck that income back into my country. Or if you're otherwise diverting profits off into low tax countries, we'll pull that income back into a place like the UK. So the concept of minimum taxes, whether they are in part of US policy or part of foreign countries who are upset about the use of tax havens, I believe is going to be in the air and in the future, and I'll turn back to that when I talk about developing countries. Third, not only are countries going to impose laws to pull back this income into their jurisdiction, but second, they are doing so through aggressive audits, lack of appeals, and all sorts of other ways that countries are mobilizing, through which they're mobilizing their ability to protect their revenue. Now to a point that Ed made, with which I think I slightly disagree. It is not at all clear, and I think the study pointed out as well, it is not at all clear that the income stripped into tax havens from the US really belongs in jurisdictions with low-function entities. In fact, Ed kind of contradicted himself because he mentioned the low level of functions that the Irish do in Ireland, yet at the same time he's defended the state aid grabbing $14 billion back into Ireland based on those low functions. So what US policymakers have to be thinking about is the fact that the income comes from the IP structures that the US, our development, our R&D, our genius in our companies, and when that's pulled back into other jurisdictions, that is money arguably that the US should be taxing in some way or another. So the foreign piece, the international piece, is not something to be ignored either for US multinationals or for its effects on the U.S. tax base. But let me also go to this issue gets blown up even more when you get to the digital economy, what people call the digital economy. Not only are the rents very high because of the extraordinary technical base on which those companies are built, but if you look at companies like a Facebook or a Google, where at least with Apple and Amazon, you got a package in the mail that was a good that was manufactured somewhere, and you can start to work off all normal parameters of international tax. But with advertising and two-sided models, what the foreign countries see are really two things. They see the fact that the company is making buckets of money in their jurisdiction, and two, that it's one of these ubiquitous presence in the world and in their space, and they want to tax some of that income. And so the question I think that US policymakers have to face going forward is do we abandon the foreign space? Do we adopt a US policy? And maybe this is a question for the territorial. Do we abandon the focus of US policy on a system of taxation globally to those forces out in the world that are moving towards a minimum tax, that are seeking to pull back income of US enterprises, which, by the way, in some territorial systems is no longer creditable in the United States. So the United States government would have very little stake in what these other countries may want to tax. So that's a question. It's part of what I'm perceiving going on in the world. I do agree that transfer pricing has been put under extraordinary strain. It's part of the problem of capital and income and residence to a great degree. I also agree that the kind of the paradigm we have of respecting separate entities and contracts is fragile. But the fragility of that is not so much that the concepts themselves, if applied between countries of equal development or equal rates, don't work. The problem is that the constructs have been used to assist in the sucking of that income off into the tax havens that we saw. And what that has done is delegitimized transfer pricing around the world and have made it very difficult to defend, in the many ways that we have to do it. Footnote, and this will sound somewhat defensive, and I suppose I mean it to be, but in the BEPS process, we were not given the opportunity to say, design a brand new global tax system. I like to say we were given that old Model T Ford and said, maybe that carburetor needs a little fixing, because if you want to walk away in the global system from transfer pricing and separate entities and contracts, you really have to ask yourself what will replace it, and what will replace it that can produce principled results with some certainty. And to me, at least, in the time we had in the BEPS project, that answer was not obvious, and I don't really think it's obvious to anyone. The next point I've made a lot, but it's kind of also in the international space, the very powerful role of the NGOs that are played around the world. So this kind of particularly European fascination with the ideas put out by the NGOs and their adoption is again a phenomenon that I think will continue. We've seen it in country-by-country reporting. You may think there's a hint of it in the state aid investigations. You're seeing it in various elements of the the ATAD, the Anti-Tax Avoidance Directive adopted by the EU. Those forces are very strong in the rest of the world, and I think we can expect those to continue as well. Let me just make a point on, I want to talk, going back to the G20, about the developing country space. And the reason I want to talk about the developing country space is, well, first of all, I'm at something sponsored by my good friends at the IMF who spend a lot of time and have taught me a lot about this space in my time at the Treasury Department. But the big thing in the G20, right, is increasing global growth. And part of increasing global growth for developing countries is something we all call domestic resource mobilization. Now, domestic resource mobilization is in large part, about helping developing countries tax their people, figure out how to reduce the informal economy. You just saw India took a move over the weekend. It's really critical that they can raise the resources to support their economies, and they can add to global growth. Why is that important? Well, I don't mean it to be like Mr. Pollyanna. It's a nice thing to do. But if you think about future U.S. markets for goods, having good growing economies around the world is a good thing. And also if you think about global stability. I'm not a defense or a national security guy, but you have to think that growth and economic opportunity around the world is probably better for stability, than its opposite. And so we have an interest in that. And the question of multinational taxation also plays a role. It's not, in my mind, the key role, which it is sometimes made out to be, but it plays a role in helping the developing countries mobilize their resources. And it's critical that that work will continue, again, apart from, side by side with, or integrated into U.S. tax reform. And in that space, you do hear calls for minimum taxes. Why? Because if a multinational wants to strip out of a poor country into Bermuda, they have a different incentive to do so if that income in Bermuda is going to wind up taxed in the United States at some minimum tax level. And indeed, more broadly, you can argue that there's a stabilizing effect of something like a min tax. But more importantly for this audience, the min tax concept is one that is becoming popular among those supporting developing country tax as ways for them to protect their tax base. And the only point I want to leave on this is, country by country reporting began in the developing country space as a concept pushed by NGOs. So I think we're going to see these concepts continue, and I think US audiences have to appreciate the fact that there's a whole world out there that debates these issues and has enormous stake in it. I'll just wrap up quickly on a couple of points. In the US, right, so when you bring all this back into the US, we have a set of international issues we care a lot about. One is base erosion, right? So if your US tax rate is something high and the foreign rate is something low, you're going to see different ways that you can erode the base, and you need to protect it. And I think to Barbara's point in the blueprint, we should all acknowledge the cash flow tax is, somebody called it earlier, a separate animal. It's very intellectually intriguing in the sense of how it takes some of our long-standing assumptions about the income tax and kind of puts them over here and creates a different debate. And it is, I think, focused on things like its effect on inversions or the effect on transfer pricing. And so it's kind of a welcome addition to a broad debate about what we do. Inversions, of course, has been a big issue for us, and the only point I want to make on inversions, at least in the traditional income tax space, is we will never get to a rate low enough that would say to companies, there's no place in the world I'd rather be headquartered. The other factor in US is leveling the playing field between domestic and foreign companies, which has already been pointed out. The foreigners get the advantages on the earnings strip and things like that. I mentioned the lockout effect, which of course everyone agrees we should do away with, but I want to caveat that the territorial systems that continue to permit US companies to strip into tax havens are going to be as prone to being attacked by things like state aid investigations and foreign countries as would locked out income as well. Two last points. One of the things the economists have taught me is they care a lot about two things. One is distributional effects of tax reform, and second, believe it or not, is revenue. I was surprised to learn when I came to Treasury that one of the things economists actually care about is whether taxes raise the revenue you need to do the things you want to do. And on distributional effects, I was struck by a quote yesterday from a guy named Jeffrey Cabaservice in the New York Times, who's the research director for the Republican Mainstream Partnership. And he wrote, if the Republican Party wants to keep its new working class constituency, it will have to make the economy work for them. The GOP is unlikely to retain these voters if most of the benefits from its tax cuts and other economic policies are seen as going to the party's most affluent supporters. Quote from a Republican, yesterday's New York Times. Another quote yesterday from Thomas Edsel's column quoted a Reuters Ipsos election day survey of 10,604 voters revealed that, quote, 72% agreed that the American economy is rigged to the advantage of the rich and the powerful. So now let's go back to distributional effects. And we know about three things. A lot of economists in here, I assume. Number one, we know that the corporate tax, in fact, it's pointed out in the blueprint that CBO, JCT, and the Treasury Department agree that the corporate income tax falls maybe 25% on labor. That's called conservative, but pick your number. But there's a great deal of that income tax that hits capital, number one. Number two, we know that the capital flows disproportionately to the higher income groups. And number three, we know that the pass-through income also flows disproportionately to the highest income groups. And so when you're hearing S-corps, small businesses, and thinking mom and pop, the distributional data tell you something else. So I would think that as we move forward in tax reform, and given the political environment we find ourselves in, these distributional issues will bubble around or not. But those are things that I think are, in the atmosphere. Finally, on revenue, I'll just simply point out that we are obviously going to enter into a phase, I think even Barbara would agree, that the numbers that are talked about in different proposals, whatever these rates are, there are kind of dials that everybody uses, right? Because at the end of the day, wherever we go, you've got to match the revenue with the expenditures that the government wants to need to do something that's economically sound. And I want to add a point about President Obama in the last several years of tax reform debate. If you take a one-time benefit on, let's say, repatriation, and say, oh, I got in the 10-year budget window, but then you're losing money in years 11 through 20, let's say on some corporate tax reform, the question really is that really fiscally sound thing to do, notwithstanding it plays within the current way we do budgets? It's a question. I also think that it's really important for everyone to understand that, and I have enormous respect for JCT, CBO, the Treasury, that the professionals in those departments that are going to be tasked with doing the revenue estimating as all these plans turn around are really going to be front and center and very, very important players as we move to the tax policy debate. Most of the economists in the room most economists that I talk to have said dynamic scoring is not going to be the politician's equivalent of the freest of free lunches, which is we can cut everyone's taxes and raise more revenue, and that's going to put that pressure back on our good professional economists in the various sections of government to look into those issues. So with that, I'll conclude.
Yeah, thanks so much, Bob, and thank you also for your service. I kind of, before I open up for questions from the floor, I kind of have this feeling that there's some thoughts that are floating around today that are mutually inconsistent. And so Thornton and I had a conversation that the corporate tax rate in the US is kind of like a fig leaf, that there are all these people who have a high rate but they don't pay it, and yet at the same time we're anxious about the revenue loss if we have a reform. It seems like that those two are kind of inconsistent. The fact is that there's a big literature that Clausing too that looks at revenue responses to changes in rates, and so I don't think, Bob, that thinking about the massive hemorrhage of revenue loss on the corporate side of this is the right way to think about it. The whole point about the multinational tax system is that we've got a high rate, we're not collecting revenue. But the second thought, and this is actually, I asked a response from Bob, is that I have this sense that people think that if there was an Olympics in transfer pricing, that the US would win the gold medal, that US firms. And it could be that that's true, but it could be true because we've got all the intellectual capital, or we have a lot of intellectual capital, or it could be it's true because of our rules. So do you think we'd win the gold medal, and do you think it's because of the current rules, or do you think it might just be because we've got all the rents?
It's a very complicated question. I will say that, let me just say this as a technical matter, right? Our own cost-sharing regulations and check-the-box rules are as much to blame for the ability of U.S. companies to kind of move money into these tax havens as is any particular multinational or the laws of foreign jurisdictions or even transfer pricing, I guess. Well, that's not true because of the buy-in payment and the cost share. So whether we'd win it or not, I don't know. I mean, the U.S. may be losing revenue. I want to go back to your first point, though. I don't think you meant to say we don't collect any revenue from the corporate income tax that needs to be replaced, right?
Well, you know, that's not what I said, so I didn't mean to say.
Well, you said we're not collecting it.
I said it's a fig leaf. It is a fig leaf. I mean, so the whole point is that you're talking about people being able to move their money around to the low tax place, and when we look at the responsiveness of revenue to changes in the corporate tax rate, we find we're on the wrong side of the Laffer curve. So
I don't know what that means.
It means if you cut the rate, you get more revenue. There's academic literature on this. I'll send you some sites. But I'm just saying that in that space, I understand the rules of the Joint Tax Committee are very important, and but revenue neutrality in front of the Joint Tax Committee is one thing. Thinking about what the economics literature says is another. And right now, to be the high tax place that's not getting revenue, it's like actually the canonical example of what the Laffer curve looks like.
But the blueprint had $4 trillion in corporate tax revenue in the next 10 years. I mean, are we getting that or not?
What do you mean? Are we going to get that revenue? Yeah. Well, the blueprint is a different thing. We're talking about changing the rate.
I'm sorry, but they were quoting CBO. So I mean, so.
All right. Well, I will open up for questions. Yes, right here in the front.
Thank you, Nick Farmer. Could you address the possibility and desirability of eliminating the business tax completely and taxing instead to get the revenue individuals, shareholders, and employees, and maintaining both revenue neutrality and distributional neutrality through whatever changes are necessary in both the individual taxes as well as the business taxes?
You want to take that?
Well, that's an interesting idea. I think parts of that idea are probably reflected in the work that Chairman Hatch and the Senate Finance Committee staff is doing on corporate integration, which is another bold idea for tax reform, focused on many of the same objectives as the blueprint in terms of making the U.S. more competitive, eliminating incentives, eliminating tax-driven incentives to move outside the U.S. Very different approach in its technical details than the blueprint, but certainly an interesting approach. The two chairmen talk often about the two approaches, and certainly from a staff perspective, it feels like having more bold ideas out there being seriously discussed and analyzed by the economists at JCT and CBO and Treasury, as well as the economists in this room and elsewhere is a good thing for the system.
I would just add that at least the economists tell me that the number of taxable individuals that hold shares in U.S. companies is relatively low, and you've got a lot of institutional investors that don't pay tax and foreign investors that don't pay tax on capital gains and have treaty benefits on dividends. And so that the amount of reduction you'd have to do, amount of increase you'd have to do in the individual rate to make up for reductions in the corporate rate is actually quite alarming or shocking or big, whichever word you want.
We have a question right there, and then I'll go back there. I've already had your question. So right here, her friend from Russia.
Yeah, Sergei Kosteyev, Financial University, Moscow, Russia. Two very short questions to Barbara Angus. Do you have a value-added tax in your proposal? And a question to Robert Stack. Did anybody from Trump transition team contacted you about getting some information? I have been reading news that Trump transition team have been really slow in reaching out. Thanks.
I'll answer mine first. No value-added tax in the blueprint.
And I won't comment on anything having to do with the transition. Thank you.
Ed, you want to jump in? Could you wait for the microphone, please? And then I'll go back here. No,
Ed needs a microphone.
This is Barbara. This is not meant to Ed Kleinbard from USC. I'm not trying to pry under the hood. I understand the rules. But the blueprint does recommend a destination-based cash flow tax with a deduction for domestic wages. And therefore, you all must have thought carefully about the WTO implications. And the simple question is, in the view of the staff and the Ways and Means Committee, is the destination-based cash flow tax WTO compliant, or instead do we have a theory about even before the election of some renegotiation of WTO understandings?
Certainly, the WTO rules were a focus, as is referenced in the blueprint. We had the opportunity to go in this direction because of the move to a cash flow tax. Destination-based cash flow tax is a case of first impression, but a cash flow tax, the economists will tell us, is a form of, it is a consumption tax, and that falls on a different side of the line of indirect and direct tax than our current income tax. We believe that there is that there is a case to be made here. We also believe it's incredibly important to make that case. In terms of thinking about the WTO issues, certainly something that we're thinking about in all aspects of design of the blueprint, both the design of the mechanics of the border adjustments and also the design of the cash flow elements of the system.
Yeah, and I'm not a lawyer and I don't know anything really about the WTO, but I do know how to write down a budget constraint, and it is mathematically identical to something that's trivially compliant. And so that gives one hope that maybe eventually the lawyers would figure that out. We've got a question or two. Eric, you've got something. And then I have to end after Eric's question. I apologize because Barbara has a very, very tight schedule right now, and I promised I'd
There's going to be a
finish on
race.
time.
Who'd like first?
Eric.
Okay, it's a question for Barbara. You mentioned simplicity, and one of the characteristics of the House GOP plan and the Trump proposal is a fairly substantial gap between the top tax rate applied to individual income and the pass-through tax rate. So my question is, how do you plan to police that boundary in a way that doesn't create a lot of complexity?
As the blueprint indicates, we certainly recognize that that's an important issue. When you move to a 25% business rate for business tax, you've got to come up with sort of the reasonable compensation component. If you just think about things sort of in a traditional corporate world, the amount that would be paid in wages, we wouldn't use those words in a partnership or pass-through world, but it's the same concept. We have been very focused on designing rules that are intended to accomplish that objective. It's a key element to this system, but it does allow it will allow the treatment of businesses that are not formed as corporations to be more comparable to the treatment of business that's done in a corporation, and for the first time it will allow sort of small businesses or mid-sized businesses that are done through pass-throughs not to be sort of subject to the top individual rate, which is a rate that wasn't designed for that kind of business income. So certainly really important element of the work we're doing.
Well, thank you very much, Barbara and Bob. In a moment, Mick Keane and Mike Devereaux are going to take the stage without a formal pause. But before they do, please join me in thanking Barbara and Bob.
Thanks for having me, Kevin.
Yes, you did very good. Thanks. Great job.